Valuing a stock can feel super overwhelming, especially if you are starting out. With so many numbers, metrics, and endless stock options flying around, where do you even begin? Well, here's the good news. I'm about to break it all down for you. In this video, I'll share one basic process that you can apply to most stocks out there. It's straightforward, beginner friendly, and by using it, you will already be ahead of 80% of new investors. At the heart of this process is the price to earnings, or also called PE ratio. This ratio compares the current stock price to its earnings per share, or EPS for short. This helps us understand how much investors are willing to pay for every dollar of earnings. But here's the catch. You need to dive deeper into this ratio wisely to get results, so let me show you how to do it. For this demonstration, I'll use Nike as an example. Nike is one of the stocks we recently reviewed, and its current trailing 12-month PE ratio is 22.25. You can find this information on any financial website, but for this example, I'll use Yahoo Finance. To dig a little bit deeper, head over to Statistics, where you will find another PE metric called the forward PE. This compares the current stock price to the expected future EPS, giving us a glimpse into what analysts anticipate for the company's earnings. For Nike, the forward PE is 33.90. Without even diving into Nike's detailed future financials, we can see that its EPS is expected to decline.
Editor jumping in. We know that the EPS is about to decline as PE and EPS are inversely correlated, meaning if PE is moving higher, like in Nike's example, the EPS should go lower, as the price is the same for both trailing PE and forward PE. Back to the video.
And just like that, in just 30 seconds, you've gained valuable insights into the stock's potential short-term trajectory. But let's take this analysis a step further. For this, we'll use Market Screener. I've included all the links to the website used in the description below. On the Market Screener website, simply type in the stock ticker, go to the financial section, and select Analyst Forecast. Scroll down to the section labeled Net Income. Net income is one of the key metrics used to calculate earnings per share, which is in turn used for the PE ratio. By looking at the analyst forecast for Nike's net income over the next 3 years, we can gain additional insights into how the PE might evolve in the future. In Nike's case, the forecast shows that net income is expected to remain below the 2024 levels for some time. However, keep in mind that earlier we looked at the trailing 12-month PE, not the 2024. To make a meaningful comparison, we also need the trailing 12-month net income. For this, let's jump back to Yahoo Finance. Navigate to Financials and look for the net income under the TTM column. And here it's around 4.9 billion. Now, comparing this side by side with the analyst's forecast, we can see that Nike isn't expected to reach this level of net income for a while. As net income stays lower, the PE ratio will move higher, making the stock appear more expensive than it does right now. Another crucial metric that beginners often overlook is diluted shares outstanding. This number provides valuable insights because it's a key component in calculating EPS. Ideally, we want to see this number declining or at least staying flat. Why? Because if the number of outstanding shares decreases, even if the company's earnings remain flat, the EPS will grow. And as the EPS increases, the PE ratio will decline, potentially making the stock look more attractive. So keeping an eye on diluted shares outstanding can help you spot opportunities that others might miss. It's a small detail, but it can make a big difference in understanding a stock's potential. And this leads us nicely to next point, that EPS and PE ratios can sometimes be misleading, as if looking only at EPS, you can think the company is growing its net income, while in reality is only buying back its shares, while business is stagnating. So always look at the net income and other metrics as well. PE and EPS are important tools, but they are just one piece of the puzzle. But before diving in and buying the stock, you'll need additional information, the most important piece. To get it, we'll use the TIKR Terminal, for which you'll need to create a free account. We can search for Nike, then navigate to Valuation tab and scroll down to find the PE ratio in trailing multiples. This section provides a historical view of where Nike's PE has traded over the years. For Nike, we can see two notable peaks, one in 2018 due to the Tax Act and another in 2020 during the pandemic. The average PE over this period is 29.61. However, I usually exclude these peaks caused by external forces to get a clear picture. After removing these anomalies, the adjusted PE averages at around 22, depending on the time frame analyzed. Based on the current PE ratio, Nike appears to be fairly valued at its current price. However, if the stock price remains unchanged and analysts' estimates for declining earnings hold true, Nike could become overvalued in the next years. This kind of historical context is important when assessing a stock valuation, so always take the time to look at the past trends before making any investment decisions. So take what you've learned and start comparing PE ratios across different companies within the same industry. Look at where companies traded in the past, and this will help you identify which stocks might offer the best value or growth potential in the near term. As mentioned, this is very basic introduction to valuation designed for beginners. I strongly encourage you to dig deeper, explore more advanced concepts, and gain a deeper understanding of the market. The more you know, the better equipped you will be to make a smarter investment decisions. If you have any questions or need further clarification, feel free to leave them in the comments below. I would love to help. And I'll see you in the next video.